What's going on, YouTube? In this video, we're going to talk about Zto Express. We just got done doing a video on FedEx, and ZTO kind of caught my eye, and I figured, you know what, let's go through it real quick and see if it's worth digging further into. So, year to date, this company is down 10%. Over the course of 1 year, this company is up 1%. So ZTO Express provides delivery and other value-added logistics services in the People's Republic of China. Okay. So the company offers delivery services for e-commerce and traditional merchants and other express service users. All right. So as of December 31st, 21, it operated a fleet of approximately, 11,000 trucks. The company was founded in 2022 and is headquartered in Shanghai. Okay. So a little quick summary of what the company is and where it's from. So what we want to go through here is the financials. So all of these numbers are in yuan, the Chinese, the RMB, I believe is the abbreviation for it. So we got to be careful of that. So really what we're going to do is just look at the percentages and then we'll look at our charts over here as well to kind of see how this company is growing. So first thing I'm seeing over here is we have our revenue to our gross profit to our net income. So we can see our revenue growing very good and our gross profit and net income both trending higher. You also see here our gross profit and net income are very close. So what we make in gross profit is almost what we make in net income. So that's pretty good. Our gross margin is just shy of 30%. Our net margin is over 20%. So good margins on this company. Our revenue and gross year over year gross margin, that is year over year change, is slowing down for sure, but is still higher and is still growing. Our year over year, including in net income, you can see our net income and our gross profit are neck and neck. I mean, it's pretty cool, pretty nice to see that. Our return on invested capital starting to trend lower a little bit, but looking to stabilize right around that 10% range. Again, I'm a fan of 15% or more, but sometimes you got to settle with what you got to settle with. So cash to debt here, we have our trend of debt we can see is starting to get kind of exponential. And our cash is just kind of hanging around here. So that's something to keep an eye on to make sure that they don't continue to borrow more and more money. So I did look into the liabilities a little bit, and it looks like all they did was just add in long-term debt, right? Which actually we can see right here. We can see total current liabilities is actually ticking up, and our total non-current liabilities is also up quite a bit, which is where your debt is coming from, your long-term debt that they're borrowing. So, total current is trending higher, but total current or total non-current liabilities you can see bounced up quite a bit last year. So we have our net income to free cash flow. So our net income continues to grow. We had a little bit of a dip here in 2020, and now we're continuing the trend higher again. And we have our free cash flow following suit. And again, I prefer to see our free cash flow a little closer to our net income, but so there's our trend on free cash flow by itself. Our share count dilution did drop off, starting to climb back up, but relatively stable in my opinion based on this chart, right? So overall, the charts and everything look pretty good. I guess the things that I would dig further into is definitely the liabilities, but we kind of already went through that a little bit. Long-term debt, I'm okay with because that's just as long as the company's growing and borrowing, I don't see any problem with that. So, and we got good free cash flow, so we can pay for everything else beyond debt. You can use debt or free cash flow to pay down that debt as well. So, not too bad, not too bad at all. So now we got our comps. We have four other companies here that we can compare ZTO to. Um, and we only see one red flag here on these valuation numbers. Operating cash flow is higher than our net income. So that is to me tells me, okay, why is our operating cash flow higher than our net income? Because our net income is what we made from the business, but now we added an additional, $600 million. And these numbers, by the way, are in USD now on this sheet. So why did we add, about $600 million of to our operating cash flow? And I'm gonna have to dig into that further to figure out why. But I'm gonna also attribute some of that to the our increase in weighted shares outstanding. So I'm gonna guess that has a bit of there's something to do with it there because we added 44 billion shares is what we added to our shares outstanding. So that could attribute to that number right there. So that could be the answer, but again, something to maybe look into. Our market cap for ZTO. So market cap is on the left, and we have our revenue here on the right-hand side. So we can see in our comparables, we are leaps and bounds ahead of the competition over here with what ZTO has for, in terms of this peer base, right? So there's obviously other companies out there that we could compare ZTO to, but the ones that I chose, I just picked four random ones, and these are the ones we got. And ZTO just destroying the current competition in terms of revenue and its current market cap. So we have our revenue, our gross profit, and income. We can see same thing. Just, I mean, we have, look at this company, look at all that revenue, but barely making any type of net income on that revenue. That's one thing I don't ever want to invest into as a business. That sure, you can make $40 billion in a year, but what if you're only bringing home, $500 million on that, $20 billion of revenue you did? Doesn't make sense to me. 5-year growth, earnings per share, and revenue. You can see GXO has a better growth rate ahead of it, but ZTO not far behind it. Gross margin, perfect. Operating margin, great. Profit margin, great. Free cash flow, I mean, just return on invested capital could be better. Again, 15% is what I like. PE ratio, we have, in terms of PE, we're in line really with the rest of the competition here. We got one company that's way up here, but HubG down here about 10. The rest right in that mid to high teens range there. So we are within range of them. We're not the highest PE ratio company. Now we come over here to the calculator to figure out what this company is worth. So, again here, Peter Lynch valuation. Peter Lynch gives it a value of $32.11 per share. Our multiples comparison gives it $27.81 per share. Our manual PE, it'll take this company 11.7 years to earn its current market cap. So, pretty good. Undervalued, 20 years. Anything below 20 years is really good. Price to book. We're sitting about, our 5-year average, just shy of our 5-year average. We have a PEG ratio currently sitting almost undervalued on the PEG ratio, and our forward PEG ratio is undervalued. Graham's valuation gives a price tag of this company of $38.80 per share. Discounted cash flow. We have a 0. I put a 0 in for analyst growth rate. We could actually do, because analysts did not have a growth rate on this company. So we'll give them a 5% growth rate. That could be low, that could be high. Based on what we see here for growth, it could be, currently they're at their highest free cash flow ever. So, we could say 10% or 5%. I'm going to give them 5%, and we'll stick with that number for now. So 5% growth rate on their free cash flow, perpetual growth rate 2.5%, weighted average cost of capital 5.14%. All those numbers, we get a future free cash flow of growth rate of 5%, gives us a terminal value of $162 billion, which would be in won. So then all these numbers have been transferred over into US dollars. So now we get a DCF price per share of $20.51. Rule 72. EPS, current PE, we have our EPS growth rates over here. Quite a spread. We have 2.5 up to 23, so that gives us an average of 16.5. 16.5 goes into 72. 4.35 times, 4.35 goes into 10 years, 2.29 times. So we're going to double our EPS once, twice, and 0.3 times, which gives us around 7 for future EPS, which gives a fair market value of $57.81 per share with a 30% margin of safety of $40.47. Finally, come over here to the summary of all of our valuations. ZTO currently trading at $24.41 per share. Our fair market value is $39.08 based on all of our other comps here. Based on all of our other calculations, We combine all our calculations. The average price is $39. We have an analyst price tag of $37.45. Again, I do not skew my numbers to try and hit or come close to analyst price tags. I come up with my own number because I know where my numbers came from and I trust the calculators that I have and use. But as we can see, usually we are relatively close to where analysts are. Sometimes we're not, but usually we're within spitting distance of where analyst price targets are anyway. But that gives us, with a 30% margin of safety, we have an acceptable buy price of around $27.36 per share. So we are below that, which is pretty nice because then that could lead to a pretty good buying opportunity on this company. And honestly, based on its financials, I'm gonna dig personally. I'm digging deeper into this company, and this might be on my buy list, and this might be a company I might be buying later today, maybe tomorrow, depending on if I find anything that I like or dislike about this company. But I think I encourage you to do the same thing, to do your own due diligence and find out if this is a company that fits your portfolio or not. One of the things that's less than ideal though is it is a Chinese company. That's not always a bad thing. I think a lot of these, if not all, Chinese companies right now are very undervalued, especially if you look into Baba or PDD. Those two companies that we valued. If you haven't, look at those two videos too. Those came in very undervalued, and I think those two are both in really good buy ranges on for especially for a long-term hold on those two Chinese companies. But let's take a look at the stock chart and see how ZTO is trading. So currently we're on a weekly chart. We've got this long-term trend line, upward trend line on this company, and it appears to be kind of holding it. We can maybe draw this line a little differently here, maybe down here, up here, however you want to draw it, but it's in that range, right? We're sitting in that range. We're creating this shorter term, well, kind of actually a longer term trend from 2020 all the way down to 20, well, to current. So we've got this wedge, this long term wedge happening here, and we're sitting at the bottom of it, and it's going to do one of two things. It's going to break through, or it's going to hold and continue higher and retest this and maybe continue to do one of these things and maybe bounce out of this wedge. If I was to place a bet, I would think this thing is going to bounce off this trend line because it has held it so many times. It could break through a little bit, but I think it might hold and continue higher. Based on financials, I think this company is worth your money, honestly. I mean, look into the news, look into the press releases, see how if this is a company that you think has a good future ahead of itself. So, but that's it for ZTO. Personally, I like the company. I'm gonna go dig deeper into it and find out if it's something that I am going to purchase in the future. But that's it for ZTO. If you found value in this video, drop a like, subscribe, comment, and we'll be back later with another stock analysis video.